end. Today's session is going to be broken down into 4 different sections. So as well as the usual Q&A session at the end, please do feel free to ask questions of our speakers throughout the session. And you can post questions using the chat function, which you'll find at the bottom of your screen. And whether it's during a discussion session or at the end, we will endeavour to address all of your questions in the time we have allocated. I should also inform you that the session is being recorded and that we will send you a link to the recording by tomorrow. And do please feel free to share that with your colleagues. And as usual, today, as I mentioned it earlier, today's working lunch will qualify for an hour of CPD, and we'll be sending you your proof of attendance with a link to this recording of the session. So over the next hour, I'm joined by Schroders Director of Intermediary Solutions, Gillian Hepburn, and their Chief Investment Officer, Alex Funk, as they review the results of the Schroders UK Financial Advisor Pulse Survey that they conducted in May this year. And joining us from the advisor community is a great friend of professional advisor, Philip Martin, the Managing Director of Unique Financial Planning. So, with all that said, let's start today's discussion. And let me pass you over to Schroders' Gillian Hepburn, who's missing a slide or two by the looks of it. There we are. Afternoon, Gillian. How are you?
Hi. Hi, Andrew. I'm very well now that we've managed to get our technology working. I think I've decided that working from home at times with the technology is a lot easier. But anyway, we're all good to go, and I'm delighted to be taking part in the working lunch today and joined by Alex and Philip. We decided to do a session on the what we've called the Pulse survey, which is a kind of interim survey that we started to do 2 years ago. We started it, we do an annual survey in November, which is kind of the big one. And then we started to do these interim ones just to check the temperature and see what was going on. And although this survey was done back in May, we still think it was really relevant to have a look at it and actually to think about whether or not things have changed since May, but also focus on some of the key themes of the survey. And it's great to have Philip on the call with us today because obviously we get this feedback from advisors, and it's always really helpful to have a discussion about why it's looking the way it is. There's 4 key areas that we're going to cover today. First of all, the market and client sentiment, and I will hand over to Alex in a minute to talk through some of the results from that section. We're then going to have a quick whistle-stop tour of sustainability. So obviously a hot topic, but what did advisors tell us about sustainability? We're then going to have a quick look at advisor activity, and this is mainly in regards to almost return to office. How are they managing clients in terms of face-to-face or using technology such as we are today? What does that look like? Or is it actually just too early to tell? And then lastly, we're going to talk about what we see as the rise in outsourcing of the investment proposition, and what did advisors tell us and why are they doing that? So a whole raft of topics that we'll cover. So without further ado, I'm going to hand over to Alex and ask him to walk through the next few slides, which is just the ones about the market. However, obviously missed the learning objectives. Clearly here it's all around understanding client sentiment and the anticipated market trends, explain changing attitudes towards sustainable investing, and discuss, as I said, the reported increase in outsourcing of the investment proposition and what are some of the selection criteria that advisors are applying. So Alex, over to you. If you could take us through the first couple of slides on client sentiment and market predictions, and then we'll have a good chat with Philip about that. And I'll also try and pick up questions as we either go along, but there'll be a session at the end where we'll do some Q&A. Alex, over to you.
Yeah, great to be on working lunch with all of you, and I think the slide is quite timely, isn't it? So what we see here is a real time of bullish investor sentiment. We've come off the back of COVID, loads of fiscal and monetary stimulus moves into the market. We see double-digit returns into 2020. 2021, we continue to see that momentum with a slight shift from growth to value. And so at that point, when we check the pulse of investors, naturally, you would expect, a slightly more bullish sentiment. I think if we take the pulse today, based on yesterday's market reaction and the last 2 days' market reaction, Gillian, I think you get slightly a different answer off the back of that, right? And I think the key message around that is that volatility is around, right? And I don't think volatility is going away. But definitely from our perspective, I think there are pockets of opportunity and that remains there. But I do think that, given at the time that we took this sort of pulse checking, I think that sentiment might have changed quite a bit as well. I suppose if we move on to the next slide. And we think around sort of client concerns as well. So, I mean, again, COVID was a period of absolute distress, wasn't it? Most of us sort of sat around, we phoned our financial advisors, we absolutely panicked during that dip. You have a 30% sell-off. Naturally, your initial fears is capital loss, right? I do think, though, that capital loss, and it would be good to get some of Philip's view on this, but capital loss will remain an investor concern through time, right? Regardless of which point in the market cycle we are. The mere fact of taking investment risk to generate excess returns over long periods of time means that we have to accept that capital loss is possible, right? Based on the fundamentals of investment. But again, I think sort of that concern sort of decreased on a relative basis, right? And other concerns came into the party around sort of income loss. And again, that was pretty well timed when it came from a dividend crisis. I think we've sort of really stabilized off the back of that, and economic growth sort of picked up. But again, I think if we take a snapshot today, or even in the last couple of months, I think investors' sentiment to capital loss will probably have increased slightly again. The media has been really good at poking the inflation fire. I think inflation has been topical all around, and we can unpack that a little bit later. That linked, with commodities prices, if you like, through the energy sector, all of that, I think, will weigh on investor sentiment. And again, it will be an important part for, I suppose, financial advisors in the way that we interact with the end investor in order to set those expectations going right. I think not to be unexpected. And if you look at the trend from November through into May, that trend sort of remains quite consistent as well. If we move on then, if we think about trends, right? And so again, I think these are quite interesting. And so I suppose the question was, how would you expect the following aspects to trend over the next 5 years? And again, the trend within the trend that says, how has that changed from November 19 through to May 21? And again, I think, some of the more topical ones were, the UK growth. I think it was really interesting. We've just come out of Brexit, which has been a very long and tedious negotiation. You had this pandemic-fueled rally, not only in the UK, but I think globally as well. And so the combination of that results in quite a bit of optimism, I think, for the UK. The UK arguably coming into 2021 was one of the more attractively valued markets, right? US was toppy, tech was toppy, Europe was looking attractive, but still expensive in some aspects. And so all of this led to quite a positive view on the UK. Again, if you had to poll investors today, I think you might have a slightly different answer to that question. But I do think there are fundamental building blocks that can be used to go forward. Interest rates and inflation, there is no doubt from the levels that we were coming from that most people would expect this to go up. And again, had we spoken in Q2, you probably would have said, no, Alex. I mean, there's no evidence that inflation is spiraling, it's transitory. The Fed, the Bank of England, the ECB is going to control this through factors of interest rates. And again, in the last 2 days, that rhetoric has probably changed slightly. And it's about a snapshot in time. I mean, things to trend lower. Clearly, the bond market has come out of 10 years of what is a secular bull market, right? I mean, you have just seen bond yields go lower, 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 which ultimately, as we know, means capital gains for investors as well. From this starting point, I think most investors will continue to believe that there's only one way for rates from here, and that tends to be on a trajectory upward. I've got some interesting view on bonds, which we can discuss maybe a little bit later as well, around what purpose do these things serve in your portfolio. I get asked this question on a daily basis. Alex, we should just sell all the government bonds in our portfolio, surely, and we can unpack that a little bit as well. And then market volatility, and again, I think it's an interesting timing perspective, because in May, I think that was quite relevant. The economy was growing quite quickly. Vaccine rates were super positive. Economies were opening up. You could see your friends again. You could hug someone, right? Fantastic. Surely that expectation of volatility is lower. But I think as we sort of move through some of these bottlenecks and fears around sort of things like stagflation and all of this coming to the fore, I think we probably see a little bit of an uptrend in volatility. It's definitely something that I've always mentioned to advisors and to people I speak around. I don't think market volatility is gone. Delta is still kicking about. We're moving into winter season. Yes, we're vaccinated. Immunity is good, but I do think there are sort of these key fundamental risks around volatility as well.
Okay.
And then lastly, I suppose I think this is the last one on market expectations, is around sort of, what style of investments. And I mean, we have all had a long career in discussing growth versus value, have we not? And I think it's a topic that most advisors and most investors are very curious about. Alex, which is going to outperform? Is it going to be value or is it going to be growth? And when is which one going to outperform? I think our personal view is that probably neither. It's not really possible to time which one outperforms when, but there were certain sort of tailwinds, from a value perspective when we took this pulse survey, right? So you had yields on the 10-year was starting to increase in the US. You had peaks of inflation starting to come through. You had really strong economic growth, right? So cyclicality came back into the market, and that was massively beneficial for value investors. I mean, if you had value in your portfolio in Q1 of this year, you'd be a very happy investor, right?
Yeah.
Vice versa, we've then seen that sort of transmission change, and it's driven around things like, inflation might not be it might be just a blip of inflation. It might be transitory. Delta might result in lockdowns again, God forbid, right? And that then started moving back into a more growth quality type aspect. And so you have this flip-flopping. It's a really bad way to explain it, but that's the way I'm seeing it in the market. We're sort of flipping on and off on these factors. And I'll be very curious to get Philip's view as well, what the market is saying. But I think at this point, it's probably going to be tilting away from typical value just because growth had such a strong Q2 again.
Sure, great. Alex, that's a great summary of what's going on, or what we found in the survey and what we think might have changed since then. Philip, can I come over to you? Obviously, we've just covered a lot there, but do you think clients are still positive about the market, or do you think things have changed in the last few months since we did our last survey?
Well, I'm not deliberately trying to duck the question, but I spend in my business quite a lot of time trying to dissuade my advisors from talking about short-term movements in markets and testing out general sentiment, because the overwhelming majority of the financial planning we're doing in our business is long-term in nature, and therefore short-term is for making tactical opportunities rather than for wholesale movements. That said, the market has obviously been, I think we'd probably all say, surprisingly buoyant over a large part of the lockdown period. It seems almost counterintuitive when retail spending has dropped to the extent that it has and cash deposits are rising to the extent that they have, but it's obviously kept on a reasonably upward trajectory. And therefore, as our advisors are doing client meetings just now, reviewing the performance of portfolios over the last 12 months, which are broadly based, covering different asset classes in risk appropriate proportions, they're having lots of pleasant conversations with extremely happy clients, and that's clearly a positive thing. And I would say that feeds into a general positivity that clients have towards the market.
Yeah. Philip, we've heard a lot about over the last year and a half, the increase in the savings ratio. For many people, that's almost been by accident rather than by design. But even the FCA, and I think it was our Financial Lives survey, identified that clients are actually holding too much cash. They were a bit nervous about volatility, quite rightly for many of them, and a little bit of a fear of what was happening in the market. And the FCA actually identified, I think the words were, could be causing harm. Do you think, you mentioned it there when you spoke, do you still think that there are clients that are holding too much in cash? And are you seeing that, or are clients starting to invest again?
Well, they're definitely investing again, but I think there are undoubted fears. I mean, you're right. I mean, the Bank of England survey was I mean, the proportion, household savings as a proportion of household disposable income virtually trebled, didn't it, at the start of the pandemic, from about 10 to 30%. And the Bank of England's own estimate is suggesting that the amount of excess accumulated savings was north of 125 billion in a 9-month period. So clearly those stocks of cash are rising. And no matter what Alex is saying about inflation and fears of inflation, as we sit with savings rates where they are, inflation where it is, that is a negative real return, and therefore value destructive if excessive amounts over and above a safety buffer are being held in cash. But I think a desire not to invest, I think, is probably more complex than just fear of volatility in the market. People have every right to fear that whether they have job security. Absolutely. If they're in jobs that don't have that, then that might demand a higher cash buffer. So I think there are a number of things in play. And I think it is absolutely the job of all of the skilled advisors that we have in this country to be explaining the just as much downside risk in having too much cash as there is in, balancing up against the volatility in the market. And I think when those conversations are had, people appreciate that there are ways that you can mitigate volatility in the market and still make sure that their money is working as hard as it possibly can for them.
Yeah, sure. Alex, we find that we're talking loads, I guess, about both inflation and what's happening with interest rates. I know you mentioned it in your session there. Is there any other comments that you want to add on to that?
Yeah, so I think lots of information will continue to come to the market, and I think if we see, Q1, Q2, there was a lot of inflation fear mongering going on, right? It was almost more topical. I mean, we did some analysis around the amount of times that inflation in the US was Googled, and it's the highest it's been in 10 years, right? And the media is partly to blame for this, right? Lots of parts of the inflation basket was clearly attributed to lockdowns and the reopening of the economy, right? We saw, secondhand cars, hotel and lodging, all of that. What I think is more interesting at this point, and it's all about data consumption at this point, is what other parts are going to start contributing to the inflation basket. So something like house prices, right? It indirectly affects inflation through owner's equivalent rent. Other aspects around sort of the energy crisis, if you want to call it, that we're facing now. Arguably, things like natural gas prices, Brent crude oil, this could be transitory as well, like we saw on lumber prices in the US, right? We saw 1,000% increases, and it's now even lower than where it was before as well. And so we need to continue to monitor that. But I think the point is that it's not about what those shocks look like in your portfolio. It's about how you design that portfolio to be able to sort of weather the storm. And, let's be frank here, if I knew exactly how inflation and interest rates are going to pan out, I'd be sitting on an island in Mauritius and not really having this call, right? And so the fact is to build that sort of weather the portfolio storm, I think it becomes important. But I think data points in the next quarter is going to be absolutely critical, with the UK probably being a little bit more hawkish, i.e. thinking inflation will be around, where the Fed is still sort of saying, yeah, we don't actually think inflation is permanent. We think there is more inflation than there was before, but it's not 5%, right? It's probably somewhere 2.5% to 3%.
Yeah.
Around interest rates, though, is the important bit, right? So we're definitely seeing some tapering. So that will naturally affect the market. As less bond buyers are in the market, that will, affect the yields. But if interest rates slowly grind up, right, which is our sort of base case, we've had a shock in the last 2 days, clear shock. But if we continue to slowly grind up to sort of the 2% mark, if companies continue to earn circa 10% what they're doing, it's not really going to affect their valuation as much. And so as long as we continue to have this backdrop of stronger economic growth, companies continue to make money, I don't think it's probably as big a concern as what it should potentially be.
Okay. You mentioned the UK there. I mean, obviously the research back in May showed that clients were really positive about UK growth. Given the current situation that we're facing with, we're seeing it all the time at the moment on the news with, the petrol shortages, the HGV drivers, challenges, supply chains. Do you think that the outlook for clients might change in terms of positivity towards UK? What's your thoughts?
Yeah, absolutely. I mean, the press that we're seeing now can't make anyone super excited about investing in the UK, right? We see sterling sold off straight off the back of that. I think the UK is a tale of two halves at this point, right? So you had a Brexit outcome, which no one thought could be achieved, right? And at the same time, you have a global pandemic to actually hide the true effects of Brexit, right? So you can't really distill from the numbers in Q4 and Q1 of this year what is attributable to Brexit and what was attributable to COVID. And so because everything was naturally quite bad in the winter, no one really thought that, Brexit wasn't a bad outcome. See, everything sort of ticked on as normal. Now you have the second half of that, where you've had, some of the negative effects of Brexit, but it's sort of been fueled because of COVID, i.e. it's really hard for Europeans to come back to do the work that they did before because they might be locked out from seeing their families again for 12 months. So you're having, this really two very distinct periods that are meshing into each other. And I think, there are definitely some positive attributes from an investment perspective, relative to global equity markets. The UK remains very attractive. It's been an unloved marketplace for 5+ years.
Sure.
As an investor, you should be looking at the UK, right? The M&A activity in the UK market, we're seeing constant bids, big bids on companies like Morrison's, right? This is showing healthy activity in the capital markets within the UK as well. Yeah. So I think from a sentiment perspective, sure, you're not going to be superly optimistic when you can't fill up your car, right? But on the other side, as an investor, it's not that unattractive, right? Valuations are attractive and longer term outcomes should be more positive.
Yeah, sure. Philip, are any of your clients asking about the situation and the UK position and growth?
Well, if you're asking if they know any way you can get petrol, but I think that's really the question you're asking. I mean, I suppose I perhaps wouldn't be. Well, I don't think you were being bullish about the short term. I think you're probably making the case for the UK in the longer term, and I could possibly get that. But I think in the short term, there will be considerably more pain, and there will be considerably more impact, and there will be considerably more negative headlines to come as this starts to unwind. I would be extremely bearish in the UK in the short term if we were setting portfolios up in that way, which,
sure,
as you know from my earlier comments, we're not.
You're not, yeah, absolutely. Well, we'll move on, but we could maybe come back to the market at the end because I'm sure there'll be lots of other questions on that one. But let's look at what happened in terms of the Pulse survey for sustainability. Alex, do you just want to cover this one? I think there's 2 slides on sustainability.
Yeah, sure. And it's an important one, I think. So one of the number one questions, and I'm sure you get this all the time as well, Gillian, is was 2020, was that a pivotal or watershed moment for ESG investing, right? Yeah. And so if we sort of look back to the data that we've got here in the Pulse survey, we can see that sort of clear marked movement that, yes, I am now going to talk more around ESG investment. I want to engage with fund managers who actively engage with companies that they own. And so the evidence is clearly here. But I think we also need to ask ourselves why that's happened, right? Yeah. And so if we think around 2020, when we were all stuck in a pretty bad place, right? So if you think around April, May, you're locked in your home, you couldn't go out, you couldn't see anyone, you fundamentally wanted to invest or support businesses that, one, would help reduce the chances of pandemics going forward, live more healthy, eat more healthy, be better people. And the second part was around sort of how the sustainable world has changed from investments. If we think, Philip, 5-10 years ago, it was all about ethical investing, right? Just negative screening, get it out of your portfolio. Now it's more around sustainable themes, aligning to UN SDGs, making a positive impact in my portfolio. And again, that style of investing hadn't seen a crash yet, right? And so 2020 had a crash across these investment styles. And in all fairness, we can talk about this a bit more later, those portfolios held up pretty well. And we saw that sort of bounce back come through. And then medical innovation, right? Surely, health tech, digital health tech is opportunistic for all of us, right? So if you think of a company like Moderna, their genome sequencing solved COVID. The vaccine was solved in 4 days, right? Their algorithms took 4 days to solve it. The balance of time to get the vaccine approved was all regulation and testing, right? And so that again is a watershed moment for investing in companies that again is attacking both environmental, social, and governance outcomes. And so I do think, a lot of this is going to change people's attitude to investments going forward.
Sure.
And that's why 2020 was probably that watershed moment.
Yeah.
And here we can see it, advisors have said that, increasing all the way from April 2020 into May 21, that COVID-19 has changed clients' attitudes towards sustainable investing. And I think initially it was a nice to have, an ESG or a sustainable portfolio. It's a have to have going forward. It's something you have to be able to offer. And arguably you have to integrate ESG not only in specific ESG mandates, but across your portfolios going forward as well.
Sure. And Philip, what's your views on this one? I mean, obviously the survey was telling us that people had a focus more on ESG and also this whole piece around stewardship. Do you think the pandemic has made people think differently about sustainability?
Well, I think it might have the short term. By the way, I completely agree with Alex. I think it's far more important to have these attributes hardwired into the attitudinal approaches that underlying fund managers are taking, rather than just badged up funds, which I guess we'll maybe come on to as the conversation emerges. But I think in the short term, well, when you see people dying round about you, you start to take stock of life in a different way, don't you? You start to think about things in a different way. I mean, I've maybe been around long enough to be a little bit cynical, and I think I'd maybe like to see what air travel looks like in 12 or 18 months once everyone's unfettered, to know if there's been a genuine conversion towards massive sustainability. But there's no question it's higher up on clients' agendas to discuss. It's obviously in the regulator's agenda, a number of things afoot around the necessity to engage with it and be able to offer it up as an option to clients. So yes is the answer to your question, is the short answer, but I think there are a number of things playing into it.
Yeah, and do you think, Philip, that with clients there's still more of a focus on the E and the environmental rather than the social and governance at this stage? Because I think probably we would think that might be the case, but it's always great to hear from somebody who's right at the coalface on this one. Pardon the pun.
I think that's right, but I think that's to do with environment and circumstances. I mean, Greta Thunberg was all over all over media yesterday because she was berating leaders. So that particular one of the three gets far more media focus and therefore is more prominent, in my mind, in clients' thoughts. But I think that's where, on the S and the G part of it, that's where the industry should be starting to take its own lead around demonstrating how it has engaged with companies, how it has made positive differences, how it has made its share of wallet affect underlying change. And I think that balance could be righted over time. But there's definitely more generally a focus. It's the one that needs the least education, because people think they understand what it means, I think.
Yeah. And speaking of education, do clients look to you for education? And if so, how can asset managers like ourselves help with that?
I think you can help in one of two ways. When I say you, I don't mean Schroders, I mean more generally.
No.
You would obviously be excellent practitioners, but I think you can help by provision of good quality, simple, unambiguous support material that helps do that. And I think more generally, the industry can help by not bandwagon jumping, which I think we can already see some evidence of. There's quite a lot of greenwashing going on. There's rebadging of existing stuff. There's whacking that label on in order to try and make something that isn't particularly attractive more attractive. And that feels a bit cynical, well, not a bit cynical, very cynical to me. And I think it would be very, very helpful to the overall cause if that behavior were curbed.
Yeah, sure. Alex, we have obviously, we launched Schroder Investment Solutions earlier in this year with a range of different model portfolios, one of which was a sustainable range. One of the big challenges always, isn't it, is this question around, is there a performance drag if you invest sustainably? How are these performing? What are we seeing in reality here?
Yeah, so it's probably 2020 again. There was that pivotal moment for the evidence around this, because I think, again, as I said, sustainable investing is fairly new. Ethical investing has been around a long time, but the portfolios have held, at least our portfolios have held up really well. And it's not so much around the crash, right? Because correlations do tend to go to one when that happens, but it's around participating on the upturn as well, right? And out of our investors, our sustainable portfolios did just as well as our sort of more traditional portfolios. So I think we're definitely moving away from that sort of myth that, yes, potentially if you're just a negative screener, yes, you would have some performance drag, right? But if you're investing for change and positive change, that is, right? There's this engagement component. It's a different style of investing. And so you're not really applying these screens on your portfolios and exclusions. And therefore, in theory, you should be investing in businesses that are going to be better businesses in 10 years. Surely the market will attribute a positive premium if you've got that decision right. Yeah. And I think that's where we are. And that's why we're not seeing the sort of performance drag that most people would have expected.
And in terms of, helping clients understand this, how important is it that our client, or that client reporting in general, kind of demonstrates all of the different factors? You've mentioned engagement and how we're making a difference and the impact that people can have depending on how they invest. How important do you think the client reporting is here?
Yeah, so from my perspective, and again, it'd be good to get Philip, it's around reporting is everything when it comes to sustainable investing, right? Being able to evidence the positive impact or positive change that you're making on, people or planet per se is really important. I do think, though, that the industry, and again, I'm speaking broadly, not about Schroders here, could have a problem with jargon, right? We're very good with jargon. And I think sustainable investing has just created another layer of jargon. And so if we can create a common platform that's easy to understand for both investors and for us, and we can all align to that, I think it results in better outcomes, because investors, they want to make a positive impact. I firmly believe that. But they just don't know how and how to see that. And so the UN Sustainable Development Goals, let's be honest, when the UN sat in a room and decided what are the 17 biggest issues in the world to solve, they didn't say, let's hand this to the fund management industry because they'll do a good job of that, right? But we've been really good adopters. I mean, I can guarantee you everyone on this call has been to see one fund manager in the last 3 months that have flashed up the UN Sustainable Development Goals in that presentation, right? And the fact is, it creates a good common platform. Investors understand climate action. Investors understand no poverty. And if we can align investments to sort of target those specific outcomes, that's a good outcome. It's positive for the investors because they understand where their money is being invested. It's positive for the planet because we're investing in companies that align to solving these issues over long periods of time. And so, I feel like it's a good common platform. But again, it'd be good to get some of your views on that as well, Philip.
Well, I think this whole issue of impact and how one measures it, I think is going to become increasingly important. So if you're going to measure impact, you need to have a methodology. And if you're going to have a methodology, ideally it would be independently verified and not by the person trying to use it for promotional purposes. So I think, and then if that's all happening in isolation from fund to fund or from manager to manager, then we're going to be comparing two different fruits in the fruit bowl, aren't we? So it does feel like at an industry level, I think there is a need to better describe how impact should be measured, have that verified by people who genuinely understand how you can come out with meaningful metrics to enable proper comparators to be made. And I think we're some way away from that just now. And I think that will lead to greater confusion. I think it's self-evident if you invest in something that affects positive change, it's either did it or didn't it. But the moment you move to by how much did it or by how much did it fail to achieve what it set out to, it becomes much more meaningful, but far, far harder to evaluate.
Okay.
Yeah.
And Philip, to what extent do you think the conversations are still, I would say, advisor-led, or are they becoming increasingly client-led in terms of people asking for, and I hate using ESG as a term because I don't think people actually ask for ESG solutions, do they? They ask for something that means that their money will be doing the right things, will have some type of positive impact. And you and I have talked a lot about this on other sessions, but what is the conversation looking like now with clients?
Well, I think the first thing you need to do is recognize that not all clients are coming from the same cohort and either have the same concerns or would place the same weight relative on each of these concerns. So it feels a bit trite to say it, but the younger the client, the higher it is up the list of things to consider, So I think that's definitely one variable. The older the client, the less important is the ESG, and the more important is that the pot doesn't run out, because it's absolutely the pressing need of today, isn't it? So I think it is age related to that extent. I think I absolutely agree it needs to be in and embedded in as part of the proposition. But I think as the offers that are out there are still some way away from being, clear, unambiguous, and able to demonstrate the good that it's making. I think when that happens, I think it'd be far easier to get client-led engagement. But we would not sit with a great number of client meetings where they've come in with an agenda to talk about switching their funds from something that was non-ESG to ESG, in the same way as I don't have anybody rolling up with £200,000 saying, I desperately need an onshore bond and half of it to go in an offshore bond. It's never, it just doesn't work that way, does it?
Yeah, no, it doesn't.
So I think it's an open conversation. And once you get to know a client, as all skilled advisors do, and understand what makes them tick, it becomes evident whether that is likely to be a major criterion for them or not. And if it is, you'll explore it further. And if it's not, you won't.
Yeah, and I think it's true, isn't it? Because we're all still on a journey with all of this, aren't we? The industry, advisors, clients alike. So, and things will continue to progress. And one of the things we've also often talked about is depending on how that client conversation is framed, could actually lead you to a certain extent down, dare I say, a rabbit hole in terms of trying to then have a proposition that meets the client's requirements, unless you go down a bespoke portfolio, which for many clients isn't the right thing. And sometimes there has to be, I think, some compromises. And I think, for Alex and I, that's why it's really important that we make sure advisors and therefore clients understand what's in the portfolios and why we're holding, certain funds and what they're doing. And because it might not, I guess it's back to your point, isn't it? Everybody's view of what they want is maybe slightly different. But some of the solutions at the moment might have not quite something for everybody. Alex, I don't know about your thoughts on this one. It can be a challenge.
Yeah, so I think, so going back to sort of the common industry ratings ability, I couldn't agree more. I think the problem is that where we are is if you look at the big players out there, right? So you've got MSCI, you've got Sustainalytics, you've got Thomson Reuters. If you ask them each to score Amazon as an ESG investment for you, you're going to get a different answer from all of them.
You sure are, yeah.
And it's quite qualitative. And so from that aspect, we've gone and said, because there's no joined up approach, we have to create something that we can rely on. And unfortunately, Philip, that's the only way to do that is to do that internally, right? And so what we said is, how else could we report this? Can we take negative externalities of a business and can we turn those non-financial aspects into financial aspects and say, if this company generated £5 of profit, how much should that profit be adjusted both upwards or downwards in order to affect the negative impact that you're having on your dirty energy that you're using or all the tobacco that you're selling, as an example, right? And I think more and more companies will start doing this, but I agree with you. We'll need to come together as an industry and say, hey guys, this is what this means. Let's get a bit joined up on this approach. But for now, the best we could possibly do is invest internally on this. Another way to measure impact, so not many people know this, but the way that we manage portfolios is on a best of breed basis, right? So it's by no means a sort of Schroder fund of funds, if you like. We invest in third-party managers as well. And one of them is the Threadneedle UK Social Bond Fund. Now, the way that we can identify impact from this fund is really crucial. The bond that was issued and purchased by the fund was clearly earmarked to build 950 care homes in the UK. Now, we can measure that, right? We can go to the fund manager and evidence that on a title deed perspective and sort of engage if that's not kept up with play. But I agree there's not enough of that going around. And that's probably what we all need to strive to be able to define that just a little bit better going forward.
I completely agree with that. I know that fund very well because I'm very involved with a big issue that
yeah, exactly.
And obviously impact is a massive part of that. I mean, there is nothing this industry loves more than a very unchallenging adjective that it can get away with for as long as possible. We might as well just call it safety, growth and opportunity and be done with it. But the real challenge should be to start to measure it in very demonstrable ways like that. And then people can make far more informed choices about the value add that's been made in running that fund. I completely agree with that.
So I'm going to move on. Obviously, we can come back to any of those topics depending on the questions that are coming through. But we asked in the survey about advisor activity, and it's probably no surprise in terms of these this slide here. we looked at what was happening back in November 2020 when we did the main survey, and then in 2021 in May. No big surprise that the majority of time was spent servicing, we call it existing clients, bottom left here. So advisors, particularly as we went into the initial stages of lockdown, spent a lot of time working with clients, as one advisor said to me, managing emotions, holding hands, helping them to stay invested, and spent a lot less time and found it more challenging, in fact, to attract new clients. As we moved forward then into this year, there was more time being spent on trying to attract new clients and think about what that would look like. Philip, what's your thoughts on that? What happened in the business in terms of this servicing existing clients and now trying to find new clients?
We might be a bit more atypical because we would have a more mature client base that you know, the majority of our advisors would have enough ongoing regular reviews with existing clients to have less capacity or less need to drive for new clients. So I suspect we might be atypical. I think that I can understand why that looks like it does. I mean, there was no question that last year was a very, I mean, it was almost pastoral in you know, in approach. I mean, you were a trusted face. You know, the world was going to hell in a handcart. There was somebody that you trusted with your, you know, your closest financial information. Regular contact was absolutely vital and was unquestionably appreciated by the clients. Weren't particularly thinking about investing more money. It was just about keeping the lights on and trying to get through the situation. I think in general, it's anecdotal, but I think, I mean, amongst the client base, it would be far less needy in that respect. And so reviews, particularly in situations where portfolios have done strongly, are maybe far less challenging than they were this time last year, and that would free that time up. So I can see why that number looks like it does. Absolutely.
And the other one we asked about was client meetings in terms of, I mean, no big surprise here that, you know, pre-COVID-19, a lot of face-to-face meetings all then switched to all remote. And that bottom part of the chart here, we asked about what's going to happen as we return to life as normal, whatever that might look like. And clearly what's coming through is this sort of hybrid kind of meeting scenario. Do you think it's maybe too early actually to tell how this is all going to map out in terms of how advisors will engage with clients going forward?
Yes, in a word. I mean, I think this is really complex because there's a big tension between how an advisor would like to do it and what the client would actually want. And for many advisors, books of clients, they will be different, and they will be different from client to client. So we will have some advisors who cannot wait to get back to face-to-face engagement with clients and will want to do it with 100% of their client book. We've got one who doesn't think he will ever physically see a client again in his life. Okay. I think they're actually both wrong. I think it will end up and settle down into hybrid. And I think, you know, as I say, what will affect that will be how the client would prefer to engage. I think it does show up the possibilities to advisors and the runners of businesses about the overall economics of face-to-face engagement on a regular basis. And therefore, there'll be some clients who it is more easy to serve economically by doing it remotely, and therefore it might, you know, continue in that basis. I would also say that one other thing that's part of this is actually less to do with what the advisor and the client would like to do, but what is safe for them to do. So we're still in a situation where it may not actually be safe for somebody that's not been vaccinated to be seeing and having face-to-face meetings with somebody who's only had one vaccine, you know, for whatever it happens to be. So we're still in a situation where we're trying to apply general COVID rules in order to keep our own people safe, but also our clients safe. And therefore, still, as we sit here today, the majority of meetings, by which I would mean close to 90%, would be taking place remotely with the approval of both sides.
Yeah, sure. I mean, that's really interesting point, that last one about, you know, we are still in a situation where things are changing or potentially changing. So it's about being safe, isn't it, at the end of the day? But So, for us, it didn't look like there was much surprise in terms of this slide, although maybe the one point I would highlight is only 7% of advisors said that they expected to go back to all face-to-face meetings. That was quite interesting for me. I thought that might be higher. But clearly, I think your point as well there is it's got to be client-led as well as, advisor-led. So it's all to play here. Yeah.
I think one other thing that the last year and a bit has driven is an ability to see more easily other engaged and associated parts of that financial planning process. So it's definitely been easier to get two partners together rather than trying to get them both out of work at the same, from different jobs into the same place at the same time. And it's been easier to start to engage with children and dependents who may be trustees or whatever, to start to explain their role in it. And that's a major change actually in terms of the quality of what we can deliver to clients, because we can start to bring the parties together more easily.
Yeah, it's a really interesting point. For many of you, you'll know that this whole piece around wealth transfer is one of my key topics that I love to talk about. And advisors are definitely telling me and backing up, Philip, what you've just said there, that having those sort of family conversations is actually made a little bit easier now that we're using technology. They can get wider family on a Zoom call, and also just the whole situation that we've been through. We talked often about how some of those family conversations can be a little bit tricky. Nobody likes to talk about mortality, but actually sometimes the family conversations have got a bit easier as people have started to think about, maybe I need to make sure my affairs are in order, and do we have a will, and do we understand what care homes are going to be like in terms of cost. So I think it's an interesting one there, that this whole meeting families on Zoom calls has had some benefits. Yeah. And so lastly, I'm just going to turn to outsourcing. I did say we'd cover a whole range of topics on this call. We do also have a report that we produced, so I'm sure Andrew can help facilitate the issue of that to anybody who would like to see the full report. But as I mentioned, Alex and I launched Schroders Investment Solutions earlier this year, so we're very keen to understand what was happening in the outsourcing landscape. And the news that was interesting for us was that 20% of advisors reported that their use of outsourced portfolio management had increased during the last year. We also asked them what the factors that they, or what did they use, in terms of decision making, and what was important to them when they moved to an outsourcing model. And probably no big surprise here, but access to investment expertise and resources, spending more time with clients, which we've talked about, volatility management. I had many advisors saying to me that they found the year when the market really dropped really challenging to explain to clients what was happening. And although the market had bounced back, they'd been, I think, I love the word, one advisor said, I was a bit spooked by it all. So we've started to work more with investment partners. So some interesting factors going on here in terms of reaching the decision to actually outsource portfolio management. And then we asked about selecting a model portfolio solution and what were the key factors. And again, probably no big surprise, but performance and cost, but also interestingly, the investment process and range of risk profiles. So a number of different factors here. Philip, in terms of your thoughts on outsourcing, do you think that these areas that we covered in the survey, does that ring true for yourselves?
Well, it definitely does for us. I mean, we've got 33 advisors, so the idea of 33 people running around and making up their own portfolios as they go along fills me with absolute dread, because it'll be me paying for the complaints. So risk control is definitely the principal driver. I mean, I think the general trend towards it was always going to happen once the regulator started to work out what was happening more generally in the market. And I've got absolutely nothing against any advisors that want to take a more active role in investment management. But if you're going to do it properly, resource it properly, write a process, make sure it's delivered consistently, adhere to it rigorously, and make sure every client that you put in it is treated in the same way. Now, that all sounds very easy in 2 sentences, but it's pretty tricky and pretty costly to actually deliver properly, isn't it? And I think the regulator clocked onto that. And probably more, more generally, I've always been very, cynical is the wrong word, I've never really believed that clients come to a financial advisor in order to have delivered to them the investment performance that they're expecting to get. I mean, I think they engage with financial advice because tax is complicated, because they might know what they're doing, but they want verification, because they want somebody around when times get tricky, because they want to be told things that they know they should do, but they'd rather not. They want to make sure that they're adequately protected. They've got difficulty buying a home. There's any number of reasons why people take financial advice. And I would put stellar investment performance down about number 14, in that from that individual in that list. So it just feels like a very, very natural pathway that we've been on for, 15 years really, towards far greater use of outsourced investment solutions. And I think that does free up financial advisors and financial planners to do the things that clients really value, which are the ones I've just talked about, I think, because that's where we can really add value.
Do you think actually one of the, I hate using the word benefit in relation to the pandemic, but do you think that it was a time when advisors really did demonstrate value to clients?
Yeah, I think if you took any form of proactive communication strategy with the clients and you were talking to them regularly, not just about investments, but just about other things, just things that strengthened our relationship, I think there's no doubt that we would take a view that our client relationships are stronger now than they were before the pandemic.
Sure. Definitely. Sure. Alex, that was an interesting point on performance, because obviously you're the man on performance and our chief investment officer, but I think to a certain extent I agree with Philip. Although performance comes out top here, I think it's just that reliability of performance, isn't it? It's people want to know that we will do what we say in the tin, so to speak. And as long as it's not, it doesn't always rate as the top factor, but it's still very important.
Agreed. And most conversations I have with advisors, it's around, it's not outsourcing. I know it feels like a horrible term. It's more like, how do we become an extension of your financial planning practice, your in-house investment team? And 95% of my time when I'm speaking with advisors, it's around the process, right? Why are we doing what we're doing? How do we do it? How do you expect us to do this going forward? And the fact is that around that sort of consistency, performance is a factor of that. And I think you probably, when you're running an investment solution that is solving specific financial planning outcomes, if you're generating portfolios that are going to be first decile performance, you're consuming way too much risk. Because the market has become so sort of concentrated, you really have to take very idiosyncratic bets to be able to get there. And that unfortunately means that when you don't get it right, you will be last quartile. And what I think advisors are looking for is that consistency aligned to that outcome, rather than to say you're the number one fund in the UK market, right? Naturally ahead of benchmark and top end of second quartile, I think is probably a place where you want to live from a performance aspect, to be honest.
Sure.
Yeah, I think that's completely right. I mean, your performance is only important to the extent that it drives the expected outcomes for the size of people's savings to deliver what they want it to deliver at the time they want it to be delivered. You see what I mean? And if it does that, it just neutralizes itself as a conversation, doesn't it?
Sure.
But if your performance is not delivering and I have to chuck in more cash every month to make up the difference, I'm not terribly happy. But
that's a problem. Yeah,
that's the problem.
Yeah. Andrew, I notice you've come online now, and thanks for your help, because I'm struggling to access the questions. So I'm going to hand over to you, assuming that you can see them, and maybe, because I think there's some come through on the chat.
There is one that's come through, and I'll just find it for you now. It's from Duncan Martinez, who asks, how do you show small cap? Is it assumed the balance or mid-large cap is in this chart? Thanks. And I think that refers to a chart that was shown earlier on. That makes.
I'm happy to take that one, Andy. So that was relating back to the factor chart that we showed, where we said, what do advisors think is going to outperform going forward. And we saw value came out top, and then quality, then momentum, and then small cap. Now, what that refers to is what we call the small cap factor bias, right? Where smaller companies are expected to grow faster and do better than larger companies over long periods of time, right? And so effectively, it's not small cap companies in the same way as you would think of a sort of a numerous index, but rather the effect of, you know, smaller companies compounding growth, i.e., are advisors more bullish on smaller businesses rather than larger businesses? And we saw that they weren't. And sort of to be expected, right? You would think COVID would have a more drastic impact on smaller businesses with smaller balance sheets than larger companies during the time when we took that sort of pulse survey.
Okay, thanks for clarifying that, Alex. Look, there's no further questions on here. We have a few minutes left, and because we were a little late starting, quite happy to overrun a wee bit. If you do have any questions, now's the time to ask them. In the meantime, let me just actually, before anything else, just a quick appeal to two of our viewers today. We've got a viewer who we can see listed as user, and one as Bailey Galaxy tab on the icons on the side of the screen. It means we can't identify who you are, and that means that we can't send you your CPD, and it also means that we can't enter you into the prize draw to win a £2,500 Cooney holiday. If you're not worried about either of those, please ignore what I've just said, but if either of those interest you, if you look in the chat function, please, on your Zoom screen, you'll see that Joe's asked you a question, just asked you to identify yourself. If you could do that, then you'll get your CPD, and who knows, you may end up with Alex on an island in Mauritius. So I'm still looking out here to see if there's any other questions. I can't see any. Philip, have you got any, a final question with perhaps we might wrap up with?
No, well, I guess maybe one thing, I mean, any of these services, one question I had was, how long have you been running it for? And are there any big swings in sentiment that you've seen from when it started to where it is now? I guess that's for you, Gillian.
Yeah, good question, Philip. The Pulse survey we've only done for the last 2 years, so we did one last year where we focused mainly on COVID. The actual advisor survey, the main one, we will run again in November, and I think we've been running that one for about 5 years now. I guess because the main advisor one has a number of different topics, and we do try and look for trends. Obviously, the ESG trend is probably I would say being the biggest one in terms of views on ESG and sustainable investing. Obviously, outsourcing for us this time round was an interesting trend, but also the economic trends. The one that we see a lot that always comes through is the impact of disruption, particularly geopolitical. What's going on in the environmental one is picked up as well. So there's a whole lot of different trends, and in fact, the report that I alluded to earlier, we're more than happy to share that, and that will take any of the people on the call through some of the trends over a longer time period.
Okay, understood.
Okay. Well, thanks everybody for your contributions today. That is all we have time for. For those of you who requested a copy of the Schroders outsourcing report, we will arrange to have a copy of that sent to you this week. But before we sign off, just let me remind you of some dates for your diary during the final quarter of this year. Next Thursday, the 7th of October, we'll be running our flagship conference, PA 360, and that's at the Brewery in London. And this will be the biggest management conference for financial advisors in the UK this year. And as well as hearing Gillian present on the importance of getting ready to serve the next generation of investors, you can listen to over 40 different speakers discussing the key management issues of running a modern advisor business. And for good measure, Robert Peston's going to be closing the day with, amongst other things, his views on issues like Brexit, China, the fuel crisis, inflation, Boris Johnson's government, and how all of this will affect you and your clients going forward. And if you're tuning in today from either the Knutsford or Birmingham areas, please look out for a personal invitation to one of 2 live working lunches that we're running with Benchmark Capital and Ruffer on the 16th of October and the 11th of November, respectively. And then finally, we'll finish up the year with our retirement planning roadshow from the 16th to the 25th of November in Harrogate, Knutsford, Birmingham, Bristol and London. Look out for more information about that, but we have a keynote presentation from Next Wealth founder Heather Hopkins, who's presenting their most recent advisor survey, good season for advisor surveys, as well as presentations for Canada Life, Denton's Pensions, HSBC Life, and 2 more sponsors that will be announced in the coming days. And all in all, that's a total of 13 and a half hours of CPD. So if that doesn't top you up before the end of the year, I don't know what will. So that's it for today's session. All that remains is for me to thank Gillian, Alex and Philip for a first class session. But let me reserve the bulk of our thanks to you, our readers, for your company this lunchtime. And I trust you found this helpful and worthwhile. And if you did, then we'll look forward to seeing you again, maybe as early as next week at PA 360. See you then. Bye-bye.